While earlier this year the Reserve Bank thought it had time on its hands and could be patient in lifting interest rates, clearly that's not the case, and they started what's going to be a series of interest rate rises in May. But in its statement on monetary policy recently, it became clear that evidence of strong inflation had actually caught the Reserve Bank by surprise. The Reserve Bank has now flip-flopped. It's changed its view. It's significantly raised its forecast for inflation, and it's cut its forecast for economic growth and unemployment. So that's what we discuss in today's podcast in what's the audio of one of my regular Property Insider chats with Dr. Andrew Wilson, Australia's leading housing economist. We're going to talk about where the Reserve Bank has changed its views, what's happening with our rental markets, what's happening with our auction markets, which are slowing down, and a few other factors that's going to give you a great insight into what's really happening on the ground and what's likely to be ahead. So welcome to today's show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
The property markets have had a lot to contend with lately, and this is showing in a downward trend in price growth as well as auction clearance rates. And recently, the Reserve Bank has changed its views. It's flip-flopped on what's ahead for our economy and our property markets. At the same time, decreasing affordability in our two big capital cities, a significant rise in mortgage rates, rising variable interest rates, the upcoming election, and a media full of stories about real estate Armageddon have dampened buyer enthusiasm. Investors are still hoping to get top dollar, and this is being reflected in falling auction clearance rates. This Saturday's auction clearance rates were the lowest reported so far this year. At the same time, rental markets continue to tighten with low vacancies and rising rents. These are just some of the property matters I'll be discussing today with Australia's leading housing economist, Dr. Andrew Wilson, Chief Economist of My Housing Market. Hi, Andrew.
Hello, Michael. It's been an exciting week, hasn't it? And lots of data that's come out. And of course, we had the shock decision by the Reserve Bank, maybe not so much of a shock, to increase interest rates for the first time in over 11 years. And they didn't just tickle them up, they put them up by their preferred increment of 0.25%. But I think the follow-up news that we had from the governor and from the quarterly statement from the Reserve Bank was very interesting.
Well, let's talk about the Reserve Bank. They did make a statement that has created some ideas about what could be happening moving forward.
Well, again, we had the quarterly statement from the Reserve Bank on economic conditions and the outlook, Michael. Once again, we had significant revisions in terms of their previous report. I think we're going to continue to see those revisions. Of course, there has been a significant flip-flop from the Reserve Bank now increasing rates. But I think that was the outlook that is most interesting in terms of the Reserve Bank's statements. They're now looking at a peak of 2.5% interest rates now, Michael, in 2024. I think that's really on the high side, but nonetheless, that's their forward guidance at the moment, 2.5% rates. They're also saying that they feel that wages won't start to grow again, and we're talking real wages here. And that's the difference between inflation and nominal wages, that they won't start to grow till 2024 either. So we're in for a 2-year period of falling real wages and by as much as 3% at their peak. So that's not good news for consumers. It's not good news for the economy going forward, Michael. I think the governor was in his interview after the announcement of the rate rise was a little questionable. He said that most of the inflation, as we know, has come from high oil prices as a result of COVID stimulus and supply constraints, and of course the Ukraine war. And the other factor has been building costs as a result of the home builder stimulus package. Well, the Reserve Bank governor has said that he expects those factors to ease quite quickly because, of course, they do measure from year to year. And going forward, we are starting to see a fall in the price of petrol. It's certainly not rising, the price of oil. So we'll see that its impact on inflation stabilise sooner rather than later. And similarly, house building costs with considerably fewer approvals coming through, that'll also start to stabilise. But yet we're going to pay the price with interest rates perhaps rising to as much as 2.5% over the next 2 years in this attempt to control inflation. And I just say to the Reserve Bank, good luck with that, guys.
Well, the Reserve Bank's hoping to keep inflation in its preferred band of 2 to 3%. But it seemed clear from the Reserve Bank statement last week that the significant inflationary shock we got came as a surprise to them, Andrew.
Yes, Michael. And we have had the hangover after the party, if I could call it that. The party, of course, was the stimulus that all economies promoted as to try to get us out of COVID. We were in certainly uncharted waters there. And the cost to that has been the constraints to supply to keep up with all that demand. And that's pushed prices up now. But of course, the question is, will wages rise in response? It's all theoretical now. It's all speculative. And the Reserve Bank admits they don't really know what's going to happen going forward. They hope that wages will rise to offset the costs of inflation, but they don't want wages to rise to the point where they're fueling inflation. And that's the conundrum, Michael. If they're cheering on higher wages, maybe they're cheering on the capacity to keep pushing up prices. And once we move past what's happening with oil and house costs, then it is the fact that higher wages will be fueling inflation generally.
It's the hard part, Andrew, isn't it? You've got to keep the economy going at a solid clip. Yes. You want to keep unemployment low. You want to return inflation to the target band, but you don't want to slow things too much to cause a recession. And people are starting to use that R word, Andrew.
I do avoid hysterical headlines, Michael, as you know, but I do think it can be a slippery slope with higher rates in terms of economic growth. In the quarterly statement, Michael, the Reserve Bank has downgraded its outlook for GDP going forward now. And we know that the US moved into negative territory in terms of its GDP over the March quarter. So this is a balancing act, and it's a very fine balancing act. And I think, Michael, we're going to be, if we get to 2.5% interest rates, we're going to be very lucky to keep our growth above the line.
Well, in the past, we had some experiences with what happened when interest rates went up, and they went up quickly. They went up multiple times, and that slowed the property markets. But is this cycle different, Andrew?
Well, perhaps it's not, Michael. That's the point. But the interesting issue in terms of macroeconomics is that lower interest rates following the GFC didn't re-stimulate the economy, didn't revive inflation. Now, perhaps we're going to learn the lesson that higher interest rates won't control inflation going forward. I mean, fingers crossed it does. But how high do you push interest rates until you perhaps recognise that the risk of a recession becomes almost self-fulfilling with those higher rates? And that's not good news going forward. If we remember the 90s, it took 10 years to reinflate our economy after the recession, the real recession of 91. Of course, it wasn't a recession, what the negative growth we had in 20 because of the COVID issues. And that reflected how quickly we bounced back. But we are now in uncharted waters, Michael. The Reserve Bank and central bank governors are all reading from those macroeconomic textbooks. And let's face it, Michael, those textbooks have been wrong for some time now.
They have. So with regard to property, I guess what happens next is going to be a function of a raft of factors, including supply, how much new building we're having, and that's down a bit, unemployment, and hopefully that's going to remain low and people are going to keep their jobs, interest rates, affordability, the population growth. What do you see ahead for our property markets?
Well, of course, we're getting all the clickbaiters up and about now, Michael, with their usual hysterical, and will obviously, if history tells us anything, they'll be wrong regarding crashes in house prices. We do remain an undersupplied housing market. We've got demand continuing to push ahead of supply. I think that will continue. Nothing's changing there. The latest building approvals data was lower over the month of March compared to February. We're still higher year on year, but that's because of the impact of that home builder allowance, that home builder policy of early last year. We've got migration to come. That will fuel demand, the opening of borders. We've got lots of stimulus packages now for first home buyers. We've got a super tight rental market, as the latest rent report has revealed. Rents are rising in most capitals at more than 10% per annum. Vacancy rates are at near low levels. That's a real drive for more investors. Investor numbers are rising to take advantage of those solid returns in the market, undersupplied, as I mentioned before. So there's plenty of positives for property going forward. We certainly won't have the capacity to push up prices as we have over the last year or two, because affordability will decline with higher interest rates. But as I said, there's plenty of offsets for that. if we do get wage increases, that'll offset the higher interest rate environment, Michael. So I'm not sure what the substance is to these predictions or the science. I don't think there's any science at all behind predictions of crashes in house prices other than, the marketing policy of clickbaiting.
Well, you talked about the rental markets, and they've really tightened over April. Your latest My Housing Market rental report showed that we're running into a rental crisis.
Well, I think we're well and truly in that mode now, Michael. It's just reinforced month after month. The two market sectors that were perhaps had supply ahead of demand were those inner city units in Sydney and CBD units in Melbourne. They're now tightening up quite significantly, Michael. Vacancy rates are falling now in those particular areas in Melbourne and Sydney for units. Perhaps the choices for those that are being squeezed out of other sections of Melbourne and Sydney are now pushing towards those unit markets in the city. And in borders, we're going to see more international students, which will increase demand for rentals, typically in those areas. And rents are starting to rise again in those Sydney and Melbourne inner city areas for units. So they were the only bright spots for tenants, but everywhere else is doom and gloom, Michael. Rents rising, vacancies falling, and there's really no prospect of this changing any time soon. I was amused that the Reserve Bank in its quarterly report mentioned that they believed that a driver of higher rents was higher incomes. I don't know how they substantiate that, because we as we know from the latest incomes data, it's still as flat as a tack, incomes growth, and we've had rents really increasing sharply for a year or more now. So not good news for tenants, Michael, but certainly a lot of interest there from landlords. And maybe going forward, Michael, as a result of this, we may see fewer and fewer 12-month leases, with landlords opting for shorter-term leases so they can take advantage of what is very strong demand at the moment.
And as you say, very little new supply coming on the market. That's in part because there's fewer new apartments being built. But the other thing is a lot of investors dropped out of the market over the last couple of years. That seems to be anecdotal evidence, but too many estate agents and others are saying their investors have sold up. And when those properties have been sold over the last year or two, it's in general been owner-occupiers buying them. So less rental stock, more people needing to rent, harder to get to become a first home buyer. So rents are on the way up.
I think it's a little bit of an urban myth that the reason we have low levels of stock in or tighter vacancy rates is investors selling up. Why would they be selling up, for goodness sake, when rents are going through the roof and prices are also continuing to rise in a number of capital city markets? I just think it's, a little bit of that soft analysis that sort of gathers some strength with any real substantiation. The reason we have fewer investors in the market, because they couldn't get a loan, Michael, thanks to APRA, and
that was leading up to it. But over the last year or two, not just in metropoles, rental properties, I read recently Ray White's had 25% decrease in the number of properties they're managing. People were silly and selling up at a time when they shouldn't, because the market was doing well. Now, Andrew, with finance, we don't look at that in advance because we see it as a leading indicator. In other words, people take out their loan applications, get pre-approvals in anticipation of what's going on. And the latest loan approvals, they rose in March, but interestingly, owner-occupier approvals flattened out. But investors, as you correctly said, are getting back into the market again.
Well, I think there were some strange results over the last couple of months. Of course, this is seasonal adjustment. And with COVID, we've had some issues with the seasonal adjustment model from the ABS. Of course, we did see a falling away in February, but bounced back in March. And I think that was a little bit of an adjustment process. But yes, Michael, and it was interesting to see that in the previous month, investor activity actually fell, which was quite interesting given the trend of the previous years. But I think we're just working our way through those seasonal adjustment methodologies because of COVID. But nonetheless, we did have a bounce back in lending activity, but it is below where it was at its previous peak. Of course, there's a lot of catch up from lockdowns in the middle of last year, early spring last year. So I guess we're just getting back to a more normalised model. But there's no doubt that investors are continuing to lead the charge in loans, Michael, and that owner-occupiers are starting to fade. No surprise because of those affordability barriers that have now stabilised the market, particularly in Melbourne and Sydney, as high prices have squeezed out buyers. Similarly, first home buyers are down, no surprise there, similarly with affordability impacting that buyer group. But, it'll be interesting to see how many first home buyers pick up the government's and the opposition's, if they become the government, their newly announced policies to stimulate first home buyers. So we might see first home buyers back in town, Michael.
Well, especially if the government's going to stump up 30% or 40% of the value of your property. That's another great discussion, because that's only going to push up property values if all of a sudden you've got a rich partner getting into the market with you.
Yeah, I know, Michael. I'm just wondering if that partner has any say if you want to do any renovations or anything.
Do you really want to have the government as your partner? Now, we looked at the demand side with finance approvals. On the supply side, the level of building approvals came out again. Now, they're lumpy and they jump from month to month, depending particularly upon how many apartment complexes are getting approval. What does the latest building approvals tell us?
Well, they were down over the month, Michael. Obviously, as you said, those month-to-month figures can be lumpy. We had a very big development come through for Melbourne in February, which has pushed Melbourne up. The other point is we've seen Perth, which had a remarkable building boom through the home builder policy environment last year. It's come back to the pack quite quickly now. Interestingly enough, maybe that's part of the drive of higher prices that are being measured in Perth now, is the fact that there aren't as many of those new homes, which perhaps were being counted in the measurement process. But certainly Perth has come back to the pack. But Melbourne's leading the charge, particularly in units. But it is about that big number that came through in February, Michael, that has Melbourne up and running. But look at the top in terms of unit approvals. But if we look on the year-on-years, the year to date is still lower, obviously accounting for home builder. But if we go back prior to the sort of the COVID environment that we've gone through over the last 2 or 3 years, we can see that numbers are just still a little bit higher now over March than March a couple of years ago. So certainly tracking at reasonable levels at the moment, but the trend is down. But we have to wait to have that home builder influence watch its way through the system. We're still well below the peak supply of dwellings that we had back in 2015, mainly through the collapse in apartment development, Michael. And so it does again underscore the undersupply that Australia faces going forward with housing.
Despite claiming we wouldn't see it happen until 2024, the Reserve Bank lifted interest rates, as we said a moment ago, 2 years ahead of schedule. And buyer hesitation seems to have been reflected now in the auction markets. They're a bit stumped by this change of tack by the Reserve Bank.
Well, we had an interesting weekend for auction activity, Michael, of course. We saw clearance rates fell sharply in a number of the capital cities. We had Melbourne down to its lowest result for the year. Sydney was steady, but it's been the underperformer in those sort of mid to lower 60 results over recent weekends. Canberra was also down. But I think the interesting point was, Michael, that we had a significant fall in the number of listings, particularly in Sydney and Melbourne over the weekend. Of course, these auctions are booked around 6 weeks ago. Yeah, that was quite interesting that we had lower listing numbers in both Melbourne and Sydney, significantly lower listing numbers. Those clearance rates were down in Melbourne particularly, and steady but low in Sydney. Maybe there's some election effect there as well, because the election was to be imminently called around about a month ago. But no doubt the auction markets in terms of clearance rates are easing now. Adelaide still remains a top performer. Canberra's still positive. Brisbane also fell at the weekend, Michael. And it'll be interesting to see going forward how our auction markets respond. But they are, of course, a leading indicator of broader housing market activity.
Well, with an election coming up, I guess there's one weekend, there won't be many auctions in a couple of weeks' time, and then it gets the quieter time in June when things slow down a little bit. So lots to keep an eye on our property markets, lots of moving parts, few people spinning plates hoping they don't fall over. So I look forward to catching up with you again next week to get your commentary on what's happening in the markets, Andrew.
Yeah, thanks a lot, Michael.
As always, Andrew's got some great insights and some good perspective, and clearly our markets are changing and will continue changing. But that doesn't mean that if you're interested in developing financial independence by building a strong property portfolio, you should sit on the sidelines. But it also doesn't mean you can buy any property either. In my mind, currently less than 4% of properties on the market are what I call investment grade. So, do you know how to select them? Yes, our property markets are changing and we are moving to the next stage of the cycle, but I know a lot of our clients at Metropole took advantage of the last couple of years. But are you ready for what's ahead? So if you're keen to take advantage of the opportunities, and there are always opportunities when other people sit and worry and wonder what's going on, why not turn to the multi-award winning team at Metropole for independent, unbiased, holistic property and wealth advice? Just go to metropole.com.au. Whether you're just getting started or wanting to grow your existing portfolio, why not have a chat with one of my team? Let us put those in your favour so you can negotiate the next few, more challenging years more safely. And remember, we don't sell properties, but we have access to every property on the market. But it all starts by building you a personalised strategic property plan. Go to metropole.com.au, and I look forward to being part of your ongoing wealth creation journey.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In today's mindset message, I'd like to remind you that your path along the road to success is going to be littered with stumbling blocks. You see, over the last couple of years, I can think of two friends who are both high-performing salespeople and who expressed a burning desire to succeed in life and in their careers. They both quit their jobs. Things got too tough and they gave up. They couldn't hack it anymore. And I've seen the same happen to property investors when the economy turns or the markets turn, or stumbling blocks are put in their way. Yet these investors and my friends, when you spoke to them, they expressed a strong desire to succeed. If you asked them a while ago, they were sure they were going to succeed. So what happened? My early mentor Jim Rohn put it well when he explained that there are three parts to desire: dreaming, the vision, and the focus. Here's what he said. First, there's the dreaming. Have you let yourself dream lately? Jim Rohn asked. Just sit down and begin to imagine all the incredible possibilities your life could become. Spend some time dreaming, Jim Rohn said. So, first step is dreaming. Number two, Jim Rohn said, is the vision. Once you dream, you begin to cut back on all the possibilities and narrow it down to the possibility which is what you really want. You begin to create a vision for your life, said Jim Rohn. You begin to see it as you want it. And then lastly, you change desire into focus. Once you've got the vision, you really have to focus on that dream. This is really when you get specific about what your life is going to look like moving forward. Now, there's also three parts for dedication, said Jim Rohn. Number one, the plan. 2, the beginning, and 3, perseverance. First is the plan, said Jim Rohn. Without a plan, you're going to drift to and fro. You're certainly not going to carry out your dream if you don't have a plan. So write it down, set your goals, know what you want and how you're going to get there. Now, you've heard that said over and over again, but in my mentorship program, I know that those people who write down their plans, write down their goals, and visualize them are much, much more likely to get them, because that's because your reticular activating system kicks in and starts looking for those things that are going to help you get there. You know that story, that if you're going to buy a white Toyota, all of a sudden you see white Toyotas all over the road. Your reticular activating system is that part of the brain that cuts out all the surplus extraneous information that's coming in and hones in as your GPS. So Jim Rohn said, what you've got to do, number one, is write down your plan. That makes sense. He said, number two is the beginning. This may sound simple, and yet it's simply profound. Many people have a dream, and they even have a plan, but they never begin. So simple. Just start. The first step on a long journey is just one step. If you've got a dream and a plan, take the step in the right direction. And then Jim Rohn said, the last thing is to persevere. Every road to every dream has a section that's hard to travel, said Jim Rohn. Every great dream will encounter difficulty. The question isn't whether or not you're going to encounter trouble, but how you're going to respond to that trouble. So my question to you is, will you quit when the going gets tough, or will you persevere? I've found that every successful person I know, myself included, has encountered problems along the way that tempted them to quit. Yet they persevered, and then they achieved their dreams. As always, wise words from America's foremost business philosopher. Your job then is to put these words into action so that the stumbling blocks along the way don't trip you over. Have a dream, have a vision, have a focus, and then write down your plan, get going, and persevere. I hope you enjoyed my chat with Andrew Wilson today, and if you did, why not go across to my YouTube channel, look for Michael Yardney on YouTube, or go to propertyinsiders.info, where every week Andrew and I have a chat about these sort of things, and clearly he brings a great perspective to the property markets. Now, if you got some benefit from it and you know somebody else who would, please tell them about the Michael Yardney podcast. Of course, you can tell the world by leaving a review. And I've got a way of saying thank you for being a listener to my podcast. Go to podcastbonus.com.au and I've got a heap of ebooks and reports for you just to help you become a better property investor. I'll be back again real soon, but you can catch me on social media in between. Just look for Michael Yardney or go to our private Facebook group. Go to Facebook and look for the Property Update private Facebook group, where every day I leave something special, something, a tip, a trick, a chart, something that I don't tell people elsewhere. As I said, I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael, but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?